In this video, we will look at the impacts on financial statements when company borrows and repays money. Why in the first place does company borrow money? This is more of a finance question rather than accounting question, but one of the apparent reasons is to expand business. If your customer is only willing to pay 30 days after sales and your supplier is only willing to sell you by cash on delivery, then you will need working capital to run daily business. This working capital requirement will increase as you expand your business, and this is part of the reason why you may want to borrow from banks to bridge the cash requirements. Another reason may be to gear up and increase equity IRR. The more company borrows, the more volatile equity becomes, hence riskier equity. However, equity will be compensated by higher IRR. Again, these are finance topics which will be covered later in the series. For now, we will purely focus on what happens to financial statements as company borrows and repays money. As always, we start from looking at a company that has just raised $100,000 capital. First thing that happens when a company borrows, say, $50,000, is its liability or debt increases by $50,000. This shows how much the company owes to the bank. At the same time, cash increases by $50,000, obviously because it borrowed money. The transaction is book debit cash $50,000, credit loan $50,000. Both sides of BS increased by $50,000, and there is no income statement impact. No income or no loss from borrowing money. Note that you may think the company's financial position is worse off because it has debt, but this is not the case because you increased cash by the same amount of debt. If the company chooses to repay debt, it can immediately repay all $50,000 by the cash it just received. It is net debt, which is debt minus available cash, that is important. You cannot just look at the company's gross debt and judge its financial stability or safety. You have to look at the net debt. Same thing when the company further borrows money. Debit cash, credit loan. When the company repays its debt, say repaying $50,000, then debit loan $50,000 and the loan decreases by the same amount, and credit cash, decreasing cash. Cash decreases by $50,000 to repay $50,000 loan.